Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we will review the latest labor force survey data. It's a theme we've been zeroing in on because it allows us to discuss many aspects of the Canadian economy, like what has gone wrong and what might be able to fix it, as well as its impact on monetary policy. Last week, we discussed the most recent GDP release and why any discussion of a recession is largely academic. Canada has been in a per capita recession for 3 years, and part of the evidence of that decline and that weakness has been the labor market. This week, we'll again break down the numbers and touch on what it means for the Bank of Canada and why they are mostly powerless to stop what's coming, and that is more job losses. So let's get into some of the details of the release. Employment declined by 65.5 thousand in August. This is the second monthly decline in a row, and as you've heard me say here before, I have questions about that plus 83 number from June, which I suspect will get revised down over the next couple months. In any event, this is not good. The labor market has been slowing for months, as you can see from the red line on the chart, and the rising unemployment rate, which we will touch on in a minute. Last month's overall decline was largely due to the fall in part-time work, while full-time work fell, but only a little bit. The second point is important because of the numbers involved. From a macro perspective, full-time work is simply more important. There are more workers, and those people are generally better paid and more productive. The problem is that when a cyclical downturn begins with full-time workers, it can take a while for it to bottom and start rising again. We'll touch on that later when we talk about the Bank of Canada. As for part-time workers, it's generally been more stable, which I always find a little bit counterintuitive. Switching gears a little bit, and it's important to remember that most Canadians work in the service-producing sectors, and that's where we saw most of the losses. This is also somewhat dispels the notion that the decline in employment was all tariff-related. Tariffs being mostly applied to goods and not services, something we'll keep an eye on going forward. We can see the breakdown here. Employment decreased across several key industries in August, led by professional, scientific, and technical services, minus 26,000, which doesn't sound like a lot, but was 1.3% in percentage terms. Transportation and warehousing fell by 23,000 people, or 2.1%, and again, that 2.1% stands out as pretty big, and manufacturing, which lost about 19,000. Weirdly, there was an increase in construction employment, which I can't quite make sense of given the housing market. Then again, it's only 1 month and you shouldn't read too much into it. And then, of course, public administration jobs increased slightly too, because they always do, apparently. Anyways, a look at the broader definition of public sector employment, however, points to a decline. It remains at a 20-year high as a percentage of total at 21.7, but at least it didn't drive all of the employment growth last month. Total ex-public employment fell by 50K. This brings us to the unemployment rate, or the share of the labor force without work, and this ticked up to 7.1%. Because different age groups naturally have different propensities to work, it's good to split it out by demographics. And again, the boomers should be happy. Those above 55 saw their unemployment rate stay steady at about 5.3, whereas the most productive Canadians, aptly named prime-age workers, saw their unemployment rise. This is not good. Mercifully, youth unemployment was steady at 14.5%. Unfortunately, this is cold comfort. Students will continue to feel the brunt of the weak labor market. For the summer of 2025 overall, the average from May to August, the unemployment rate for returning students aged 15 to 24 was 17.9%. And as you can see, this is a historically very high number. The rise in youth unemployment is partly cyclical. In a downturn, young people get fired first or not hired at all, but it's also in part because of the temporary foreign worker program run amok. And although it is true that the skilled share, yellow and green, is higher than it was in 2024 than in any year previous between 2015 and 2023, the absolute number of unskilled, the red and the blue, has risen a lot. And of course, this affects the youth unemployment, which mostly work unskilled jobs. The people who are saying that the rise in temporary foreign workers has not affected youth unemployment are gaslighting an entire generation. Of course it has. How stupid and reckless the broader immigration policy has been is made very clear with the following chart. Since January of 2023, Canada's population has grown by 2.2 million. This is 4 times the number of private sector jobs has been created. This is totally bananas. And finally, before we discuss the implications for the Bank of Canada, the collapse in the employment rate for the total economy, an extension of the previous chart, now sits at what looks like a 26-year low. The participation rate for prime age workers, which represents the portion of prime age workers that is either employed or unemployed and actively looking for work, has also fallen. And for the most important workers in Canada, it is now at a 5-year low. After years of being high and relatively stable, people are leaving the labor force. Unemployment rate gets a lot of the headlines, but that red line should really be the focus. It falling means that people have become discouraged and have stopped looking for work, a real indicator of the state of the economy, which along with the rising unemployment rate is why I continue to say that we have been in a recession for years. So what does this all mean for the BOC? Well, despite being a single mandate central bank targeting inflation alone, the labor force survey employment data all but assures a September rate cut. And as you can see, there's now an 81% probability of the September cut, although I'll admit it has fallen a little bit over the last few days. Now, I believe this rate cut is a mistake. Inflation, as I've shared with you last month, is rising, but more importantly, lower rates will not address any of Canada's underlying problems. Poor productivity, weak private capex, capital flight, a bloated bureaucracy, a record tax take, high debts, anti-oil regulation, and housing affordability. Negative real interest rates, i.e., policy below the level of core inflation, not only do not address the problems, they are in part the cause of the situation that we find ourselves in. They fuel malinvestment and they siphon capital away from non-residential investment, entrenching inequality. Nevertheless, in my view, the train has left the station, and although the Feds and the BOC will try their best to stop it, I believe that things will continue to get worse before they get better. Such is the nature of an economic cycle. All right, that's a wrap on this week's episode. Thank you very much for watching. Please like and subscribe. It helps me with the algos. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.